Welcome to the deep dive. We cut through the noise to give you the core insights, quick. Today, we're really getting into early wealth building. For listeners maybe in their 20s who get that time as, well, it's their biggest asset, and they're ready to maybe make some sacrifices now for bigger gains down the road. Our source today is really interesting. It's excerpts from A Millennial's Guide to Wealth in 20s. And this isn't just theory. It's based on the author's own path, getting to a very significant net worth before hitting 30. So yeah, our mission here is to pull out those foundational steps, the daily habits you really can't skip if you want that kind of growth. If you're looking for something more than just save your money, I think this is it. Okay, let's unpack this.
Yeah, what jumps out right away is this guide kind of rejects that slow, steady approach. It's much more about maximizing leverage through intense discipline, especially in your 20s.
Right.
It sees that decade not just for earning, but as this critical time to build systems that basically guarantee that compounding effect kicks in hard.
That focus on systems, on habits, that's really the core theme, isn't it? The source is pretty clear. Getting wealthy fast isn't about some lucky stock pick. It's almost entirely about these specific daily actions and getting the basics right, like an intensity playbook.
And that intensity, especially in your 20s, it's just so crucial. I mean, when you're starting out, time is doing the heavy lifting for you, right?
Yeah.
Saving, say, an extra 5% now, the impact that has years down the line is exponentially bigger than doing the same thing 10 years later. This guide really gets that maximizing your time horizon is, well, it's the best advantage a young person has.
Which means you need a solid foundation, absolutely rock solid. The guide lays out these four foundational pillars, things you need to tackle immediately, starting with what it sees as the most damaging thing in personal finance. Pillar 1, non-negotiable, debt management. Specifically, just explicitly avoiding all consumer debt.
All of it.
Credit cards you don't pay off, personal loans, those high-interest car payments. Basically anything where you're paying interest on something that's losing value.
Yeah.
Or just paying to consume now.
The thinking is pretty simple, really. Consumer debt just digs a hole. It actively works against everything you're trying to save.
Right.
I mean, if your investments make 7%, but your credit card costs you 20%, you're going backwards fast. So the source treats that kind of debt like a financial fire. Put it out before you even think about serious wealth building.
Okay, but you can't just ignore the whole credit system, right? So pillar 2 is kind of related, but it's constructive. Credit building. Even if you're dodging debt like the plague, you still need to build a good credit history. Responsibly, of course.
Yeah, that score is your key later on. For the big stuff. Mortgages, maybe business loans with decent rates. It's like the entry ticket for playing in the major leagues of wealth building.
Okay, makes sense. Then pillar 3 is the engine, income generation. The source talks about getting practical work experience, high-value stuff. But this part, it feels a bit different from standard advice.
How so?
It's not just get a job. It's about aggressively cranking up the amount of money coming in.
Exactly. You can't save aggressively if your income just stays flat. What's really key here is the focus on stacking skills and negotiation. The guide suggests maybe every 6 months or every year in your 20s, you should be actively trying to learn a new marketable skill or figure out how to make money from the skills you already have, side hustles, that sort of thing.
So constantly checking your market value. It actually encourages you to push for a real raise every year, not just wait for that standard 3% bump.
Right.
And be willing to switch jobs if your current one isn't keeping up with the income growth you need. It demands this sort of professional restlessness.
Which leads perfectly into the last pillar. And this one's maybe the most critical for that rapid accumulation idea, maximizing savings.
This is where the intensity really shows up.
Yeah. It's very prescriptive. Living well below your means. That's the phrase.
Okay, but hang on. We're talking about people in their 20s. Telling them to live well below their means. Doesn't that just sound like a recipe for burnout? Is there any, balance mentioned?
It acknowledges it's tough, definitely. But the argument is that this intense phase is temporary, and it's leveraged. To put a number on it, because well below your means is vague. The guide suggests aiming for a savings rate, not just 10 or 15%, but pushing towards 50% or even higher of your take-home pay.
50%? Wow. Okay.
Yeah, and the only way to do that is to really know that gap. Income versus spending, quantify it. For instance, it suggests trying to keep housing costs around 20% of income, which is way less than the usual 30% advice you hear.
Right.
That kind of rigor. It's like keeping your powder dry, financially speaking. Every possible dollar goes towards buying assets, not lifestyle creep. It shaves years off the time it takes to reach financial independence. That's the payoff.
Okay, so once you've maximized that gap, saved aggressively,
Hmm?
then you shift from defense to offense, getting into passive wealth strategies, moving beyond the foundation to actually investing. Strategy 1 is all about efficiency, using tax-advantaged investment accounts to the max. The guide specifically mentions opening and, crucially, maxing out things like, well, here might be an ISA, or in the U.S., a 401k or Roth IRA, whatever lets your money grow without taxes eating into it every year.
Yeah, that's a point beginners often miss. They just look at the return number. But if you're accumulating fast, taxes can take a huge bite. 15, 20% of your gains gone each year. Using these accounts means it compounds tax-free or tax-deferred. You're basically using the rules to keep more of your own money working for you. It's a mechanical edge you just can't afford to ignore.
And strategy 2 gets into what you actually put in those accounts. And the recommendation is, well, it's radically simple. Invest in a simple 3-fund portfolio made up entirely of low-cost index funds. So for anyone new to this, it means you're not trying to pick winning stocks or chase hot sectors. It's deliberately boring, almost.
Boring is good here.
Right. But what are these 3 funds, typically?
It's usually super straightforward. They aim to cover basically the whole global market. So you'd have one fund for the total U.S. stock market, one for the total international stock market, and one for the total bond market. Investing like that means you're betting on the long-term growth of the entire economy. It spreads out your risk, minimizes the danger of any single company blowing up on you, maximum diversification, minimum fuss.
That combination, simplicity and tax efficiency. It's powerful.
Yeah, it is. You cut out complexity, you slash fees, which is huge over decades, and you just ride the market's passive growth. It takes emotion out of it, takes the need for constant tinkering out, frees you up, really.
Frees you up to focus on the hard part.
Exactly. Maximizing that income and savings rate we talk about.
Which brings us to the mindset part, the stuff that actually fuels this whole system. And this is where it gets really interesting for me, the way it puts 2 seemingly opposite ideas together. First, there's the extreme discipline side. You have to track all your spending meticulously.
Every dollar.
Not just the big bills. Every coffee, every subscription, using an app, a spreadsheet, whatever.
Absolutely. That tracking is your feedback loop. It's how you know if you're actually hitting that, say, 50% savings target, or if you've got leaks you need to plug. It demands real honesty with yourself, attention to detail. And yeah, it's uncomfortable for a lot of people because it makes you face your habits, good and bad.
Right. But then, alongside that intense tracking, the guide says you also need to actively seek out discomfort in another way.
Yeah.
By taking calculated, uncomfortable risks for growth, both personal and financial.
Yeah.
That feels like a total contradiction at first glance. How do you square that? Micromanaging pennies on one hand, taking big leaps on the other?
Well, if we connect it back, it actually makes perfect sense, I think. That strict tracking, the aggressive saving, that builds your financial safety net. It gives you the capital, the cushion, to actually afford to take a calculated risk. Someone living paycheck to paycheck, they can't just take 3 months off unpaid to switch careers, or drop serious money on a certification, or start a side business that might, fail initially.
Right, they don't have the buffer.
Exactly. So a calculated risk isn't just rolling the dice, it's using that strong financial base, the big savings, the zero consumer debt, to make a move that has high potential. The guide really stresses that growth, especially in your 20s, often means taking on challenging jobs, maybe moving somewhere expensive but full of opportunity, or investing in education that boosts your earning power long term. You use the tracking and saving to minimize the downside, so you can take those strategic leaps to maximize the upside.
So the discipline isn't about restricting yourself. It's actually what creates the freedom to take those calculated chances. You manage the baseline tightly, so you have the resources, and maybe the confidence too, to make moves that really accelerate things.
Okay. So what does this all mean when we put it together? We've covered quite a bit, from daily habits to investment strategy. The core takeaways from this guide seem pretty clear, though. Discipline habits are number 1. Absolutely no consumer debt. Aggressively saving, quantifying that gap, embracing that simple 3-fund index fund approach in tax-friendly accounts, and maybe underpinning it all, tracking every single dollar. Yeah, the guide makes it really clear. Early wealth comes from living lean, investing broadly, but also Critically, by actively pushing past stagnation in your career. It's really a call to action, high-stakes planning, not just sitting back and waiting. And if that core lesson is about taking calculated risk for growth, then maybe the final thought for you, the listener, is this. Based on the financial stability you're building, or maybe you need to start building with these steps, what's the specific uncomfortable risk you need to take for your next jump? Is it asking for that big raise?
Yeah.
Launching the side project? Investing heavily in a new skill? That's the
Fair.
difference, right?
Right.
Between just a rash move and a smart leverage bet on yourself. That's the question this whole philosophy kind of forces you to answer. Now,